Hi everyone, welcome to the TSP webinar. Thank you all for joining us after our winter break, although it's still a bit wintry out there. Just a quick housekeeping to start off with. We would be grateful for any feedback you have after this session. There's a lot of new first-timers joining us today, so in particular, any feedback from yourselves, gratefully received. There is a questionnaire comes out when we send out the slide pack, or you can simply email me. Let us know what's good, what's these things. It's only the third one we've run, so we really do need to know what you like and what you don't. Things like timing. We're thinking about alternating morning and afternoon. So if that works, that's fine. If not, let us know. So that's fine. Otherwise, the only other thing I was going to say was when it comes to questions, please could you type your questions into the questions and answers tab that you should find, and we'll pick them up. If you've got any questions, it's probably better to type them in as you think of them. At the end of each section, we have a questions and answers section where I'll pick them up, and I will and then for the presenter to respond to. So that's it. So what are we doing right today? We're going to start off with some quick sort of news headlines, just sort of a heads up that what things are happening. There's been quite a lot happening in the last 3 months, so there's a lot on the list. We're going to be very briefly, less than a minute on each topic. So, but it's just really as a heads up more than anything else. That's going to be, and then we're going to go into some Brexit and capital tax reforms discussions, which are both pretty hot topics at the moment, given where we are. So, speakers, I'm Chris Holmes, and you may know me as one of the tax line consultants. Mark Ellis heads up the indirect tax teams that helps all of our the VAT line queries. He's going to be helping me with the hot topics. We then got Paul Townsend, who's a partner in Birmingham, who sort of gets close to our TSP clients there, and he'll be running the CGT update. And Juliet is part of Mark's indirect tax teams, who's a customs specialist who helps us out as well when we have customs queries. Right, so let's start on with the news items and myself. So, right, so these are going to be very quick. Self-assessment. There's a few things to say. I think everyone's aware that the rules for late filing penalties has been slightly tweaked, in that the revenue are basically going to accept reasonable excuse for an extra month till the end of February. If tax returns are filed within February, then they'll automatically be assumed to have a reasonable excuse. It's important to note that the tax return is officially late, so all the other consequences will apply, extended audit periods and things. So just it's just that there will be no late filing penalty automatically applied. Time to pay arrangements. You may be aware that there is a facility for self-assessment taxpayers to agree a time to pay online automatically. It's if your liability under self-assessment for an individual is less than 30 grand, you can apply to have your tax automatically recovered over 12 equal installments. The key point there, that originally said you had to file your tax return by the 31st of January, but following the previous amendment, they actually just said you have to file the tax return by the time you make the claim. So that there was an adjustment in these rules accordingly. But I say it's a useful thing. It means you don't have to phone out. Any other time to pay arrangements, you will have to go through the phone in the normal way. Right. A new point. There's an easing going out on this probably today. There seems to be. The revenue seem to be saying that they're going to be checking ID for about 10% of all repayment claims that are being made under self-assessment. So that means about 10% of the repayment claims, they're going to be asking the individual for passports, driving licenses, birth certificates, plus a copy of the bank statement for the bank that's stated on the tax return. And if they're under CIS and under employment, they want copies of the P60s and relevant evidence of tax withheld and all this sort of thing. So this is it seems to be this it's not widely known, and we've only learned about it from a conversation we had with the revenue. So it's a bit of a watch this space to see exactly how it entails. But we're told 10% of taxpayers. So you just got to be aware if you get this, that's what it might be. Right, it's a random selection here. Warshaw case. If you are a nerd like me, you might have noticed, you might have been aware of the Warshaw case, which is all about the definition of ordinary shares. And this particular case was for the old entrepreneurs relief. It's basically gone through the upper tribunal now, who have agreed the rulings in the first tier, in that these particular shares were considered to be ordinary share capital. It's a bit of an odd case because it actually disagreed with what was written in the revenue manuals at the time. It was actually a taxpayer took the case because without it, they didn't qualify for ER. And what it basically says is that although the preference shares has a fixed return of X%, the fact is that if dividends weren't paid, the next dividend that was paid had to be calculated with not just with reference to the par value of the shares, but with reference to the unpaid dividends. And what the courts have decided is that as the amount on which the fixed rate is charged is variable, we haven't got fixed dividends, and therefore the ordinary shares. So it's a very odd case. But anyway, it's more out of interest than anything else. It's gone through the upper tier tribunal now. Right. Simple reminder that IR35 still applies. So there's a lot of the revenue have categorically said that it will that it will apply from the 6th of April. They came out and said that there's going to be no deferment. So you need to be prepared, whether you might be working for a large company that falls within the rules or the contractors, but you will certainly find that is you'll be talking to your clients about that a lot more in the next thing. Right, what is the next one? Right, warning on cryptocurrencies. You may be aware that the HMRC have now obtained information from a lot of crypto currency traders or the platforms that are based in the UK, and they're getting information from around the world as well. So they're getting a lot of information around bitcoins and other assets, other crypto assets. So on that basis, we can pretty much expect HMRC to start launching inquiries into these. They certainly believe that a lot of the gains that people are making on cryptocurrencies are simply not being disclosed. So on that basis, our client, if you've got clients who have been involved, you might want to have a word with them about their disclosures. Right. Moving on. National minimum wage. You may have noticed last month the HMRC reinstated their naming and shaming list. So people who are caught by national minimum wage are now being named on the internet. And we're not talking about, I mean, I've got the list in front of me. We're not necessarily talking about big companies here. We've got some which are, it does start off with Tesco's £5 million underpaid to a huge number of staff, but it actually talks about anyone who there's the smallest one on the list, the last one on the list is a nursing home that underpaid one person £510. So I think it's just bearing in mind that, just to reiterate, the national minimum wage is quite an important thing, and if you get it wrong, to be put on the consequences are far beyond having to pay the employee. There's penalties, there's naming and shaming. And bearing in mind, the revenue headline for this is rogue employers named and shamed. Are these people all rogue? Probably not. A lot of them have probably just made mistakes. So it is just a reminder that NMW is an important thing as we go forward. Right. CJRS post-November. Talking to our in-house specialist on the coronavirus job retention scheme, the media all talks about an extension to the rules, but actually the rules for post-November rules have changed quite significantly. So they're saying we shouldn't be thinking about an extension. We should be thinking about sort of a CGS 3, a new set of rules, and making sure we check. So my understanding is that there's a lot of people out there who are applying, who are just thinking it's the same as before and just applying the old rules where they shouldn't strictly be. They may not necessarily apply, and errors are being made as a result. So it's just worth double checking that people claiming now are properly claiming. So that's the first point. Deadlines for making claims are literally 14 or 15 days after the end of the month. So for January, the claim date was actually the 14th of February. Well, it was 15th of February yesterday. So you only have a short period of time, although you can, if you have a reasonable excuse, you can extend the deadline slightly. The last point is one which just came to light at the weekend. HMRC have discovered an error in their calculator that affected 2021, and they've issued some guidance on how to correct that around. Just got a quick copy here. If the error results in an overclaim, then amend this in the next claim or repay online. If the error results in an underclaim, call HMRC helpline and amend one, and amend by the 1st of March. So there's some guidance on HMRC website about what you need to do. Right, on the last point, DAX 6. You may have maybe read DAX 6. It's the European cross-border version of DOTAS. It's an EU initiative. We were all signed up for. On the 31st of December, the government decided to announce that we were not going to be that they weren't going to implement DAX 6, and instead we'd go to the much watered down OECD model. So if you have been looking about this, then the rules have now changed, and the OECD model talks about arrangements which have the effect of undermining reporting requirements for the automatic exchange of information, and arrangements which obscure beneficial ownership and involve the use of offshore entities and structure with no commercial substance. So those are the type of things that are going to be caught now going forward. I should say, if you've got international clients who have subsidiaries and things in Europe, then you'll still be caught by DAX 6 in respect to those subsidiaries. Right, that was I'm out of breath now. That was the direct tax. So over to Mark.
Hello, can you hear me all?
Yes.
Super. So on VAT, we've got I think it's about 6 points to cover. The first point was something that was announced nearly 6 months ago by HMRC. They'd said that compensation, termination, damages payments were all actually subject to VAT, and they always were, contrary to their published guidance and their views about such things, where they said a lot of those kind of things were outside the scope of VAT. So that was quite a worry for the sector for two reasons. One, I might owe some VAT to HMRC that I didn't know. I did from 2, 3, 4 years ago on a transaction I did then, and what the heck do I do about that, given that HMRC's guidance at the time said otherwise, that they wouldn't want any of that. But two, much more important thing, which is that you can't trust anything HMRC say. And to this day, I still have people phoning HMRC or asking them questions. And I go, really? Are you really still doing that? Given that you have public things like this, where they just do a complete U-turn on published guidance, let alone what they've just told you over the phone. So they cannot be trusted to be consistent and stick by what they've said. And then in a further twist, as this point says, they've done a U-turn. They've now turned around and said, we've thought about it a bit more and we'll put this on hold, our change of views, and get back to you soon. So another U-turn, given that the industry and advisory bodies turned around and said this is outrageous. So again, a further reason to get good advice from somebody who knows about VAT, a VAT advisor, rather than ask HMRC. The second point is around the payment of deferred VAT liabilities. So these are people who took advantage of the automatic VAT deferral nearly a year ago that was announced by the Chancellor. to alleviate impact of lockdown at the time. A lot of people deferred VAT payments, which they were allowed to do. The new scheme is about to open. It should open, I think it's in a week from now. The online portal will be open, but you've got a deadline to opt in of 21st of June to get your clients to log into this. But I'm sure there'll be some clients who'll just not realise this is going on, even though it'll be publicised everywhere. And I still have clients going, "What's Brexit?" which amazes me to this day. But some people miss these things. So if any of your clients have deferred this VAT from last year, they need to have this brought to their attention that they will have to do something quite soon. Log on to a portal and then decide how many payments they want to make to clear their VAT liabilities over the course of the coming year. Another thing that is coming, lots of people hoped it would be delayed again, but it won't, which is construction-related services, flipping the liability for paying the output VAT on such services over to the customer in certain circumstances. So that's already been delayed twice and is not going to be delayed again. So that is coming around on the 1st of March. Affects more people than you know. There's a lot of people out there who do work on buildings. Construction related services is very widely drawn. It's effectively anything that is captured by the construction industry scheme as a service for that. And then you work your way down in terms of, well, is the person I'm supplying it to registered for that or required to be registered? That's interesting. You've got to decide that. Registered for the CIS or required to be registered for the CIS. That's quite interesting, with end users potentially being liable as deemed contractors, potentially liable to be registered for the CIS. So there's lots of things for people who are in that property related or groundworks or anything like that. Basically anything that's construction industry scheme related to think about. They won't be able to get away with. It'll be delayed again. It won't be delayed. It's coming in. Could you flick on to the next slide? Thank you. Option to tax notification. I have queries every day about this. Yes, the option to tax for options to tax made after 2008. In order to be effective, you have to notify it as well to HMRC. So this is quite important that they were saying within 30 days of making your option, which could be a board minute or whatever else you did to make to say I've decided to opt to tax, you had to notify HMRC with the relevant form or just with a letter will do within 30 days. They'd made that 90 days, and that extension, it being 90 days, you have to notify HMRC of your option. That's due to end on 31st of March. No news about it. About that, lasting a bit longer at this point. So assume that's going away, and we'll be back to 30 days notification deadline of an option to tax if those made after 31 March. And then the last point, again, this is something that's been delayed, won't be delayed again. So this is the more important bit of making tax digital for VAT, which is about digital links, which most people who aren't tech savvy, their eyes glaze over. Basically means no more copy and paste. And lots of things that are done like that with data. Data has to be seamlessly flowing from IT systems into spreadsheets and between tabs on spreadsheets. No more of that pretending that the spreadsheet you've got on your screen is basically a piece of paper and I'll move things around. That's got to stop. The reason, again, that this is not being delayed is because it's a revenue raiser for HMRC. If businesses make less errors because it's been automated properly, their process for doing VAT returns, then HMRC spends far less time dealing with what I would call silly errors, as in spreadsheets haven't had rows added up correctly and things like that. So this is unlikely to be delayed. I think the parting comment would be here, there's two ways to view the whole thing, making tax digital for VAT. One is to view it as something I have to comply with, and if I don't, and I have an error in 12 months' time, and I haven't got everything compliant with this law, then I'm going to have a hard time convincing HMRC I shouldn't be penalised for my error because I was taking reasonable care. It's a bit difficult if you weren't complying fully with their law on making tax digital for VAT and having a fully automated VAT return process. That's a stick. The carrot, though, which I've said to quite a few clients, is to say, well, wouldn't it be lovely if I had a fully automated process? It's not a finance process that anybody in the finance team could do, not just that one poor unlucky person in the corner who got left with the VAT, the VAT short straw, and they end up doing it, and nobody knows what the heck they do. That surely should be better. Anybody should be able to do it, and also there should be an automated checking process, and also a sheet that the reviewer would say, well, these automated checks have shown this, and I've done my own checks, and they say that. That's just like any other finance process. That would be a good place to be, and so that's a positive way of viewing this legislation, as it's an incentive to make a change in an area that's desperately needed that change for a long time, to make it the same as all other finance functions. That's it for me. Over to the next slide.
Right. Well, thank you, Mark. A very whistle-stop tour there of lots of points. If you've got any questions you want to type in, there's none so far. So if nothing comes in, we will move on. If you have got any questions, you can still feel free to type in. We'll pick them up at the end. So if there's no more, okay, let's move on to Juliet, I believe.
Yeah, hi there. Can you hear me?
Yes, I can.
Great, lovely. Okay, if we could move on to the next slide, please. So what I'm going to run through today is, as part of Brexit, from a customs perspective, an issue that is causing a lot of confusion with clients, and this is the new trade relationship with the EU, the Trade and Cooperation Agreement. So this is our trade deal. Now, we are finding when we are speaking to clients, there are a lot of misconceptions out there. So what I'm going to do today is run through some of the most commonly found misconceptions or perceptions that we see, the reality of them, and then talk you through some of the key areas of this agreement which are causing client confusion and difficulties. So running through these, the reality versus the perceptions. The first one that we have had from clients is, well, we have a trade deal now, so there should be no customs formalities when we move goods between the UK and the EU. The reality is that's incorrect. We still have customs formalities in place. Companies are now required to do customs declarations or arrange for these to be submitted on their behalf to HMRC when goods are imported into the UK and exported from the UK, and likewise when goods enter or leave the EU, customs declarations are required for EU customs authorities. The second perception, well, we have a trade deal, therefore it is tariff-free access across the board. We don't have to worry about duty coming in on goods that we're importing from the EU. This is not correct. The TCA allows for the possibility of tariff-free access, i.e. goods moving between the EU and the UK without duty being required. It allows for the possibility. It is not a blanket coverage. There is a key concept here that this tariff-free access is only given if the goods in question can meet preferential origin status. If they can't meet this status, then customs duty and tariffs will still be due, even if goods are physically moving from the EU to the UK and vice versa. Preferential origin status is all therefore linked with the customs origin of the goods. So the one thing that companies are now having to look at far more closely is where do their goods originate from. And when we talk about originate here, we talk about economic value. It's the economic passport of those goods. So the origin of goods is key. So then clients say, well, if I buy from an EU supplier, that must mean the goods are of EU origin. Not necessarily. The supplier could be buying those goods from China, bringing them into the EU and then selling them to the UK. In that scenario, those goods are of Chinese origin. Place of supply does not necessarily equate with origin of the goods. So a common pitfall that clients are falling into. Okay, so I'm buying something from a supplier in the EU and they're telling me those goods are of EU origin. Can I just believe them? No, not necessarily. Again, the customs authorities will check as a matter of good compliance and risk minimization. Companies should be checking this out and checking the origin of those goods. Well, another thing we get from clients is, well, I think the goods are being manufactured in the EU. Haven't seen anything from my supplier, but I think we're okay. So I'm all right to say that my goods are of EU preferential origin, or conversely, we're doing some sort of manufacturing on our goods in the UK. We're okay to say the goods are of UK preferential origin so that when we sell to our customers in the EU, they don't have to pay any tariffs. Are we okay to do that? No. Again, the rules around this are very strict. If you don't have evidence about the origin of your goods, you shouldn't claim preferential origin. Finally, well, HMRC, particularly for imports into the UK from the EU at the moment, are taking a relaxed approach. They're not introducing full border checks for the first 6 months of this year. We don't really need to worry about this, do we? Actually, you do, because both HMRC and EU customs authorities can retrospectively audit companies which are claiming tariff-free access or zero duty at import, or alternatively are exporting goods with this preferential origin status, and they can retrospectively check going back 3 years. And what's more, under the terms of the agreement, if, for example, the German Customs Authority wants HMRC to do an origin audit on a UK company, HMRC is legally obliged to do this. So, from a matter of future risk compliance, companies need to be aware that what they're doing now can be checked in the future. Next slide, please. So I said that this tariff-free access only comes about if goods have preferential origin status. In order to get this preferential origin status, origin rules have to be met, and there are specific origin rules under the agreement. And we have 4 different types of origin rules. So the key message here for clients and is not straightforward. It is actually very complex. So clients thinking, because we do a bit of production, we do a bit of assembly, we do a bit of processing in the UK, we're fine, or our supplier does in the EU. That is not the case. They have to meet a specific rule of origin for the types of goods they are either importing or exporting. Now, these rules of origin, to make things slightly more complicated, are applied based on the classification of the goods. So if companies haven't classified their goods correctly for customs purposes, they won't be applying the correct rules of origin. These rules of origin, 4 main types: either the materials used have to change classification under the UK tariff, from materials to the finished product, or there is a specific prescribed production process which must be met, or we then get on the concept of non-originating versus originating materials, non-originating and materials which don't come from either the EU or the UK, and there is a limit as to the level of these that can be used, or the final rule, which tends to be more for agricultural food products, is it has to come from either animals that have been raised in that country, or things like milk. It has to be produced or grown or wholly obtained. So we have these 4 types of rules. Now, to make things more complicated, under certain parts of the tariff, for certain commodity codes, companies can choose between an option, so maybe 3 options, depending on which one is best for them, or alternatively, they may have to meet a number of criteria to satisfy one rule. So to reiterate, this is incredibly complex area. We have found we can speak to clients and we can spend 3 or 4 hours talking about this to get into the necessary level of detail. So again, the message here is clients really need to understand the level of detail they are going to have to go into. And all of this, the main purpose is to make sure that there is sufficient economic value in what is being moved between the 2-party customs territories, so between the UK and the EU. This is all designed to make sure that companies can't, for example, import cheap goods from China or somewhere like that and pass them off as either UK or EU originating goods. Could we move on to the next slide, please? So in these 2 slides here, I have a couple of examples which have been taken from the actual TCA agreement itself, just to show you the level of complexity that we are dealing with. So what we have on the screen now is the excerpt from the annex to the TCA, which contains all the various rules of origin. And as you can see in the left-hand column, we have the classification. So these are goods which are falling in chapters 4 of the UK tariff. So as I said, the first thing the client has got to do is identify their classification, and then they look at the rule. So here for chapter 4, as you can see, we have 2 criteria. So this is for dairy products. So 2 criteria, all the materials are wholly obtained, and we have an additional requirement which says if you're going to use materials at heading 1701, which is sugars, they can't be more than 20% of the weight of the product. So again, really technical and detailed. Further down, we have an example of the rules of origin for goods falling under chapter 33, which is perfumes or cosmetic preparations. Here you can see the client or the company can choose from 3 separate rules of origin. So they choose one, they have an option, and these are things like a change in tariff subheading, a specific process, or that added value element. Next slide, please. To go, if you will, to the most extreme of the rules of origin, we're now in the area of textiles. As you can see here, to give you an example, the client can choose one of 7 options. But again, it gives you an idea of the level of detail that has to be met. Next slide, please. So when we talk about the TCA, we've got some key concepts. So as I mentioned, we have these rules of origin. I've shown you some examples there, and they're contained in the annex to the agreement, and the application of the rule of origin is determined by your customs classification. Now, another common error that clients and companies make is they go straight to this annex, they find the relevant rule of origin, they look at it and they think, great, we know what we're dealing with. But that's not the whole story. You have to read these rules of origin in conjunction with the main body of the TCA, the main body of the agreement, because that provides further notes and guidance as to how to apply the rules. We have other key concept things like tolerances. You do have 10% tolerance rules if you can't quite meet the applicable rule of origin in certain circumstances. We have something called insufficient production rules. Now, this is really catching companies out, and I'll talk about this in a bit more detail in the next slide. But this basically says, if you're doing simple processing, it's not sufficient. Whatever you're doing has got to be sufficient processing or production. We have things called non-alteration rules, which effectively mean you've got to move goods pretty much directly from one country to the other. They're not supposed to go elsewhere beforehand. Evidence of origin. The agreement lays down requirements around origin. How do you prove that your goods originate? And then finally, the concept that is really catching companies out is accumulation. And we'll talk about that in a bit more detail on the next slide. Could you move on, please? So, accumulation, this is a concept which is common to all free trade agreements, because that's what the TCA is. It's a free trade agreement. So the thing that probably gets overlooked quite a lot is the UK has entered into a free trade agreement, this TCA with the EU. We've also entered into quite a few other free trade agreements with other third countries. A lot of these were free trade agreements that we were party to when we were in the EU. We've just extended them and rolled them over into new agreements. So what we're talking about here is quite common to all these free trade agreements. And this concept of accumulation, as I said, is fairly normal. What it says is if we have got processing and materials originating in one party to the agreement, so in our case, the EU, the UK, we can use them to count towards originating status in the other party. And this is the basic concept of accumulation. It's called bilateral accumulation. But if I'm bringing something in from the EU, it doesn't automatically count as UK originating. I have to have a production process. And this is where we heard a lot of noise about this in the media in last month. And one of the examples was the M&S Percy pig scenario. And this is where M&S were importing Percy pig sweets into the UK from the EU, it was Germany, in fact. They were bringing them into their warehouse in the UK. They were repackaging them, ready to go to their supermarkets in the Republic of Ireland. And when these Percy pig sweets were going into the Republic of Ireland, they were attracting customs duty. And people said, well, how can this be? These sweets originated in the EU. They've just come into the UK. They've just been repackaged. They're going back to the EU. How come we're paying duty on them? The problem was because when those sweets came into the UK, yes, they qualified for duty-free when they came into the UK because they were of EU preferential origin. But the production that was done on them in the UK thereafter, i.e. that simple repackaging, wasn't sufficient to give them UK preferential origin, so that when they went back into the EU, tariffs were paid on them. So this is being brought about because there is a basic concept under EU legislation that once goods leave the EU, they lose their EU status. And if they're re-imported back in, they're treated as third country. Now, unfortunately, when they were negotiating this agreement, they didn't put an article or a provision into that which overrides this. It is in place in some free trade agreements that the EU has with third countries, but it was missed out from this one. So a lot of clients, a lot of companies out there scratching their heads thinking, why, if I'm bringing something into the UK from the EU and it's of EU origin, why on earth am I paying duty on it that I'm then sending it, particularly in this case, to the Republic of Ireland? And that is why, because it's lost its EU status at that time. Okay, that's it from me. Thanks, Chris.
So I forgot to take myself off mute. Thank you very much. I can tell you talk to a lot of people on this by the way you talk. One question's come in. It was while you were talking about the appendixes, but I'm not sure if that's relevant. Are all of these forms online or paper? So I guess that's part of the process of filing. So.
Well, the TCA, obviously, you can access that online, and that's really your main starting point. So that the Trade and Cooperation Agreement, yes, that's online. There's also a very helpful UK government notice, which expands and provides a bit more clarification upon that. But that is really your starting point, the TCA, the text of the agreement.
Okay, I've had another couple of questions come in. I have a client who does promotional merchandising, so the goods are imported. They do brand printing and send them out again. Does this attract duties?
Again, we would have to look at the relevant rules of origin. So we'd have to, as I said before, first step, let's classify those goods, then let's look at the rules of origin and let's see what it says. As I tried to point out there are different rules of origin, and just because it would qualify under one rule of origin doesn't mean it would necessarily qualify under another. So the answer there is we have to treat each one on an individual case.
Okay. How did customs even realise to check M&S if they're not checking now, and assume if you say it was UK that it did originate indeed in the UK? Also, how can one possibly be penalised on these new rules that even the professionals don't fully grasp? So,
well, I mean, it's a very good question, and I think what we will see is we are already seeing more and more clarification coming out on this. To put it into context, this agreement came in on the 29th of December, so it's noticeable by its lack of detail compared to other free trade agreements, which tend to have a lot more information in them. This one is short on detail, which is actually why there is confusion around this. So in my own personal opinion, what I think is we will have a period of time where things settle down and we get further clarification. But again, going back to one of my earlier points, HMRC and the EU customs authorities, they do have this mutual cooperation agreement that they will undertake retrospective audits. So it is one that companies should really try to be getting on top of now, because you could be stung by this in the future. But yes, agree. It's a difficult one, isn't it? With the lack of clarity in some respects at the moment.
Well, there's no more questions coming in, so I guess we should move on to Paul, as he's running out of time. So straight on to you, Paul.
Morning, everybody. So I'm going to talk this morning about capital taxes reform, the prospects of it, and really look at the reports that people have published over the last couple of years, to see if we can pull out some themes. But as an opening comment, I would say that I've been doing tax now for 25 years, and when I did my CTA in 1998, the vast majority of what was in that exam still forms the basis of the capital tax systems of today. So some would argue that we're well overdue a change. So next page, please. So who's looked at the capital taxes and when? First of all, the Office of Tax Simplification. Now, the Office of Tax Simplification are an independent body, but appointed by the Exchequer, and they kicked all this off back in November 18 when they looked at the administrative aspects of IHT. In the summer of 19, they did a report on policy matters relating to inheritance tax. And then as late as the November of last year, they did the third of their reports, which is a report on capital gains tax, which would included a consideration of rates. An all-party working group of MPs has also looked into this. So that was at the beginning of 2020, and they looked at inheritance tax and intergenerational fairness. And then finally, the Wealth Commission, and they are an independent think tank, but they do receive some of their funding from the government. And they looked at whether a wealth tax should be introduced. And again, that was the back end of 2020. Everybody on this call will know that there's been a massive amount of speculation as to whether we're going to get tax rises in the budget, particularly in respect of CGT. I'm afraid I don't have a crystal ball, so I can't predict that. And I can also not predict whether that would come in on budget day or on the 6th of April. But what I can say is we're doing a huge amount of planning at the moment to get transactions through ahead of the budget. So people are transacting at least under known rules. So if we talk through each of those in turn, Chris, could we click on? So inheritance tax and the Office of Tax Simplification. As the name suggests, they looked at how the current complex system could be simplified. And they kicked that off really by looking at the system for lifetime gifts. So currently we have a very complex system for lifetime gifts, annual gifts exemption, gifts in contemplation of marriage, obviously the nil rate band. And importantly for our wealthier clients, if you make regular gifts out of surplus income, then they are immediately free of inheritance tax. Now, the OTS said that that system, a complex system, should be largely removed altogether and simply replaced by a more generous annual exemption, perhaps as little as £20,000 or so. Importantly, they say that the PET regime, the potentially exempt transfer regime, which currently means that gifts fall out of inheritance tax after 7 years, should remain. But they say that's quite burdensome on executors. It's a tough job to work out what someone's done 7 years ago. So they say instead of having to survive the 7 years, you should just have to survive 5, which is obviously more generous. But they then say taper relief, which reduces the rate of tax on transfers of value after 3 years of being completed post-gift, that should go. So it will then become a cliff edge. Either the full 40% rate would apply if you die within the 5 years, or you would immediately then go to 0% rate on the following day. They looked at inheritance tax reliefs and their interaction with capital gains tax. Now, currently, we've got this very generous system where if you leave an asset free of inheritance tax, whether that's under the spousal exemption or because it's covered by business property relief or agricultural property relief, then the person who inherits it from you on death receives it at market value. They say that's too generous, unsurprisingly, and they say that that uplift on death should be removed. And that might mean people will be more willing to pass on farms and businesses during their lifetime, obviously with the then hope that they'll then survive the required 7 or 5 years to get it outside the scope of inheritance tax. Importantly, for our business clients, they say that agricultural property relief and business property relief should remain. However, they do think some tweaks should be made. Firstly, they say currently for a company to qualify for business property relief, it needs to be mainly trading, and that's a 51% test. And they say that should be changed to bring it into line with capital gains tax, holdover relief and gift relief, and that should be an 80% trading requirement. So your ability to shelter investment assets within a trading group would be severely reduced. They say in the modern economy, a lot of joint ventures now take place. And where you've got joint ventures that are trading entities, currently, if you don't have a 51% interest in that it's regarded as an investment rather than a trading activity, and they say that should be looked at, presumably arguing that it should be brought into the trading basket. And then finally, they say in terms of inheritance tax, there's and capital gains tax on furnished holiday lets, there's an inconsistency in the rules between inheritance tax, income tax, and capital gains tax, and they should bring it all that into alignment, which seems sensible. And finally, when you take out life cover, if that is just pays to your estate, then the payout is chargeable to inheritance tax. So people normally write policies into trust to ensure it doesn't fall into their estates. So they're saying, and again, very helpfully, that requirement should be removed. The requirement to write it into trust should be removed, and it should just come. It should be able to come into your estate and not suffer inheritance tax. So that's the OTS's recommendation. So if we can move on to the all-party working group MPs, Chris. So the all-party working group of MPs took a radically different approach. And they noted that actually the richer you get, once you get to a certain point, capital inheritance tax rates actually fall, not rise, which obviously isn't in line with a progressive tax system. So what they've said, and this is very radical, is that all the exemptions, other than the spousal exemption, for lifetime gifts should be removed. So any gifts over £30,000 in any tax year would be immediately chargeable to inheritance tax, albeit that would be at just a 10% rate instead of obviously current risk of a 40% rate. Then on death, they say again it should be a lower rate of between 10 and 20%. If you've died and you've made gifts during your lifetime, they shouldn't be brought back and reconsidered on your death. They say the 325 nil rate ban should remain, and the ability to transfer that to your spouse if you don't fully utilise it should remain. However, they say that the rather overly complex, in my view, residence nil rate ban should go. And then in terms of the big relief, so agricultural property relief and business property relief for our clients, and this is a really, really important one, is they say those should go all together. So your business would be subject to inheritance tax, albeit at a much lower rate than currently. But they recognise that that would put a huge amount of stress on businesses, and therefore say that they should have time to pay over 10 years. Like the Office of Tax Simplification, they say that the CGT uplift on death should go if you've for both lifetime, they say for both lifetime and death gifts, and for non-UK domiciliaries, they say that they should be subject to inheritance tax on their worldwide assets after they've been in the UK for 10 out of the last 15 years. So currently, assets in excluded property trusts, i.e. trusts settled by someone before they become UK resident, are outside the scope of UK inheritance tax. They say that they've announced some pretty radical changes to that. And the current 10-year charge for trusts. So trusts are subject to 10-year anniversary charges, most trusts, at up to 6%. And they say instead of that, they should capital distributions from a trust should be brought within that lifetime charge at 10%. And finally, and I know I'm going through this quite quickly because of lack of time, but finally they're saying obligations. There should be an obligation to report all gifts over a minimum each year, and that minimum they're suggesting is over just £10,000. So that will give the revenue lots of information in terms of what gifts have been made, I suppose, to ensure that that 10% tax charge on lifetime gifts is picked up and it doesn't evade tax. Next slide, please, Steve. Chris. So then, relatively recently, the Office of Tax Simplification looked at capital gains tax. And importantly, the Chancellor asked them to consider not only the regime, but also rates. And obviously that increased the speculation that rates will go up in the budget. So the recommendations they made, and they always express it in terms of recommendations of what the Chancellor might like to consider. They say if simplification is a priority to the Chancellor, then the government should consider more closely aligning capital gains tax and income tax rates. And they should also address the boundary issues between capital gains tax and income tax, which makes the calculation of tax difficult. So obviously the speculation on that is what they're actually saying is rates for CGT should come much more closely to income tax rates. If they did so, then they note that obviously a lot of your capital gain is simply the fact that inflation increases the value of your underlying assets each year. So they're suggesting that indexation allowances should be reintroduced. And they're also saying that, well, if you're going to pay tax at higher rates on capital gains, then it would be fair for more flexible use of capital losses against income. They're saying the number of rates for capital gains tax is overly complex, so the opportunity should be taken to slim down the number of rates. And they've also taken a look at employee share schemes. As we all know, employee share schemes can give very favourable rates of tax, and they question whether those are overly generous and whether the tax applied to employee share options, etc., even under approved schemes, should be closer to those for income tax. And then they've also looked at what they call boundary issues in respect of micro or small entities, and they define that in terms of the Companies Act definition. So some quite big businesses would be caught. And they say a couple of things that should be looked at there is whether retained earnings in a business should be taxed at a higher rate when that business is finally liquidated or the shares are sold. And they're also saying that where you do not distribute your profits in one of these smaller businesses, should a higher corporation tax be applied to those profits? I assume as an incentive for companies not to be used as money boxes and for profits to be distributed. They say that the current capital gains tax annual exemption is too generous and should be reduced to perhaps to £4,000, but with a broadening of the chattels exemption. And then they've also suggest, obviously now where we've got sales of residential property, we've got the 30-day rule and you have to pay your capital gains tax within 30 days. They're saying that a similar system should be introduced for CGT, and obviously that would have a big impact on wealth managers who would effectively need to report in real time to their customers to let them know what CGT needed to effectively be paid on account, with it then brought onto the tax return at the end of the year to true up the correct amount of tax paid. And then finally, again, that interaction with inheritance tax, they also note, this is the third report that notes it, they say that where you have that CGT uplift on death, that should be removed where you're not paid inheritance tax. But they do suggest there should be perhaps a rebasing to 2000 values, an extension of holdover requirements to a broader range of assets. So to bring that all together, that all amounts to, I think, very substantial changes to capital taxes probably on the horizon. Is it likely to take place in the current budget? I very much doubt it, because quite frankly, the government have other things on their mind at the moment with COVID and with Brexit. But but is it likely that we will see reforms over coming years? I would say it's highly likely. And is it likely that the new regimes will be less beneficial than they currently are? I think that is also a high likelihood. But as I say, I have no crystal ball, and therefore you like me would just need to consider all these reports and advise clients appropriately. But it is an uncertain environment, and that's why we're having so many client queries on this. Okay, then, Chris, that's one final slide. So wealth taxes. Obviously, we've never had a history in the UK of wealth taxes. The Conservative manifesto said that they were opposed to it, and the Chancellor has repeated that. And he said that he would be in favour instead of CGT rises. So this Wealth Commission, who are an independent think tank, have given it some thought, and they've concluded that it would be a lot easier to overhaul inheritance tax and capital gains tax rather than creating a whole new wealth tax. But they do say that a one-off wealth tax could be an opportunity to raise very, very significant sums of money. So they say, for instance, that a 5% charge on all assets over £500,000 would raise £260 billion, which I think is just about what the government has spent on COVID. They say if a wealth tax were to be brought in, then it should be on the worldwide assets of UK resident individuals with no particular exemptions or reliefs. They say that all trust assets should also be chargeable if it was settled by a UK resident. And they say that, I suppose, in order to avoid a flow of assets abroad, the valuation date for that one-off wealth tax should be set on or before the date that the policy is introduced. And I guess, as I say, that would be to avoid a massive outflow of funds from the UK to foreign relatives. So as I say, there's a lot to take in there, a lot to consider, and major changes are likely to be on the cards. Back to you, Chris.
Thanks, Paul. Right. There's one question coming. Just wondering what your thoughts are on whether there will be anti-forestalling CGT rate increase on transactions rushed through before the budget, like they did for ER. What are your thoughts? So, do you want to take that?
We discuss this.
We discuss this all the time, don't we? Yeah.
And I think probably the answer is yes. We would expect some kind of anti-forestalling. I mean, what we've got the one, and I suppose if.
Well, my thought, for what it's worth, is if there's going to be anti-forestalling, it almost needs to be the change has to take effect on budget day. And I'm struggling to see a CGT rate increase being on budget day rather than the 6th of April. There's only ever once been one previous rate of increase for personal tax mid-year, and that was when the 18% was increased in July 2011 following the change in government. So unless if it's reliefs and things, then yes, but otherwise, I'm struggling to see, how can you turn around and say we're increasing the rate from the 6th of April, but if you enter in a transaction in the next 30 days between now and then, we're going to tax you at those new rates. It seems, but they could do. We don't know. I think that's the interest. That's the thing.
I think about announcing an increase in capital gains tax rates in nearly a month's time. I suppose the speculation is whether that would have an adverse effect on the markets.
Yeah.
Because they did it when taper went. We had a run-in for that, didn't we, back in it was 2008.
And they got a lot of money for it.
And they got a lot of money in. And of course, they need a lot of money now. So that was only in respect of business assets. So if it was a general rate of capital gains tax across all assets, would the government fear that there would be a run on the market?
I think they've abolished ER, then they might well do, because that's a change in reliefs that could be applied on the day. But I think they've just done that. So what would they do with that again? That's my thought. And I said the other thing was, I mean, this is talk about transactions rushed through before budget day. I mean, if we have a genuine commercial transaction sale to a third party, I don't see I think it's unlikely there's anti-forestalling, because if you think about it, even the ones that were last year didn't affect those genuine transactions to third party. They were all around elections where there was no real substance in the change in ownership.
Yeah, so I was going to say, in terms of those transactions, they looked at what anti-forestalling they would have wanted last year.
Yeah.
Why would you not have a similar anti-forestalling rules this time around? But it's all speculation.
Yeah, exactly. So I think the answer is clear. We don't know. So, but it could be. It all depends on exactly what the changes are and when they take effect. I think it's going to be the answer. I mean, my gut feeling is we're going to get a rate change in 2022, but that's just mine. So that's it. It could be anything. Right. Don't think there's any other questions. So lastly, just to thank everybody for attending. Thank you for the speakers. Just to remind you that we would appreciate any feedback, whether on the form that gets sent around or simply email myself. We are planning to do another webinar shortly after the budget. It may not necessarily be immediately after, so it may be more of a draft Finance Act review rather than a post-Brexit. The firm itself is running a post-Brexit webinar on the morning after the budget, so you're welcome to register for that should you wish. But yes, and to answer the question just come in, yes, we will be making slides available to all the attendees. So whoever's come along, we will send a set of the slides along. So thank you very much for coming along.